Welcome to our comprehensive guide on clearing, settlement, and risk management in exchange-traded currency derivatives. In this video, we'll break down the key mechanisms that keep the currency derivatives market running smoothly and securely. Whether you're a finance student, a market participant, or just curious about how these complex systems work, you'll find valuable insights here. We'll start by exploring the roles of clearing corporations, move through the step-by-step process of clearing and settlement, and then dive into the robust risk management frameworks that protect the market. Let's begin by understanding the foundational concepts that underpin every trade in this dynamic segment. Clearing corporations are the backbone of the exchange-traded currency derivatives market. Registered with SEBI, these entities are responsible for the clearing and settlement of all trades executed on the exchange. Acting as a legal counterparty, the clearing corporation guarantees the financial settlement of every trade, ensuring that buyers and sellers receive what they are due. This process not only builds trust but also reduces counterparty risk. The clearing corporation works closely with clearing members and clearing banks to manage the flow of funds and securities, making sure that obligations are met efficiently and securely. Clearing and settlement mechanism is a systematic process that determines the open positions and obligations of clearing members. Clearing involves aggregating the positions of all brokers and custodial participants, which are then used to calculate daily margins and exposures. Settlement follows, using a multilateral netting procedure to determine net obligations, meaning each clearing member either pays in or receives funds and securities. This two-way process ensures that all trades are settled efficiently, with daily settlements typically occurring on a T+1 basis and final settlements on T+2. The clearing corporation announces the settlement schedule regularly, keeping all participants informed. Understanding pay-in and payout is crucial for grasping the settlement process. Pay-in refers to the phase where clearing members bring in money or securities to the clearing corporation, marking the start of settlement. Payout is the subsequent phase where the clearing corporation delivers money or securities to the clearing members. These processes are timed precisely, with daily settlements on T+1 and final settlements on T+2. The clearing corporation ensures that all obligations are met before the market opens, maintaining the integrity and smooth functioning of the market. Several key entities play vital roles in the clearing and settlement of exchange-traded currency derivatives. The clearing corporation stands at the center, supported by clearing members, clearing banks, depositories, and depository participants. Each entity has specific responsibilities. Clearing members handle the clearing and settlement of trades for their clients, clearing banks manage the flow of funds, and depositories facilitate the electronic holding and transfer of security. This network of entities ensures that every trade is processed accurately, securely, and in compliance with regulatory standards. Clearing corporation performs three main functions: clearing and settlement of transactions, risk management, and acting as a central counterparty. Through a process called novation, it becomes the buyer to every seller and the seller to every buyer, guaranteeing the completion of all trades. This central role is critical in managing risk and ensuring that defaults by any party do not disrupt the market. The clearing corporation also determines fund and security obligations, collects margins, and coordinates with other intermediaries to process settlements efficiently. Clearing members are essential intermediaries with specific rights and responsibilities. There are three main types: professional clearing members (PCMs), trading cum clearing members (TCMs), and trading cum self-clearing members (SCMs). PCMs have only clearing rights and do not trade themselves, focusing on clearing trades for others. TCMs can both trade and clear for themselves and others, while SCMs handle only their own trades and those of their clients, not custodial participants. Each type plays a unique role in ensuring that trades are cleared and settled efficiently. Clearing members are responsible for the clearing and settlement of all deals executed by trading members who clear through them. Their key functions include computing the obligations of trading members, performing actual settlements, setting position limits, and monitoring positions continuously. They also confirm trades for custodial participants and ensure that all regulatory and risk management requirements are met. By maintaining strict oversight, clearing members help maintain the stability and reliability of the market. Clearing banks act as vital intermediaries between clearing members and the clearing corporation. Every clearing member must maintain an account with a designated clearing bank, used exclusively for clearing and settlement operations. On pay-in days, clearing banks debit the clearing member's account to meet fund obligations, and on payout days, they credit the account with the settlement amount. This streamlined process ensures that all fund transfers are handled securely and efficiently, supporting the overall settlement mechanism. Depositories play a crucial role in the electronic holding and transfer of securities. By maintaining ownership and transfer records in electronic form, they enable paperless trading and ensure the speed, accuracy, and safety of transactions. Depository participants (DPs) act as agents, providing services to clients. In the context of exchange-traded currency derivatives, depositories and DPs mainly handle the pledge and repledge of securities as collateral for margins, supporting the risk management framework. Interoperability among clearing corporations is a significant advancement introduced by SEBI. This framework allows clearing members to choose their preferred clearing corporation for settling trades across multiple exchanges. By linking multiple clearing corporations, market participants can consolidate their clearing and settlement functions, leading to better capital utilization, reduced costs, and enhanced market competition. Interoperability also reduces operational complexity and aggregate exposure, making the market more efficient and resilient. Under the interoperability framework, recognized clearing corporations establish peer-to-peer links, allowing seamless settlement of trades across exchanges. Clearing corporations maintain special arrangements and exchange margins and financial resources on a reciprocal basis. To manage interclearing corporation exposures, sufficient collateral is maintained to cover any defaults. This ensures that even if one clearing corporation defaults, others are protected from financial loss, maintaining the stability of the entire market ecosystem. Clearing mechanism involves calculating open positions and obligations for each clearing member. Open positions are determined by aggregating proprietary and client positions, with no netting across clients or between proprietary and client accounts. Each trading member's open position is the sum of their proprietary and client positions, and these are further aggregated at the clearing member level. This approach ensures accurate exposure and margin calculations, supporting robust risk management. Once trades are executed, they're cleared on a netted basis by the clearing corporation. Clearing members are responsible for all obligations arising from these trades, including payment of margins, penalties, and settlement of obligations. If a clearing member is not a trading member, they still settle trades for the trading members and custodial participants they represent. This structure ensures that all trades are settled efficiently and in compliance with regulation. Custodial participants can trade through multiple trading members, but clear and settle through a single clearing member. They must register with the clearing corporation and obtain a unique code. Trades entered by custodial participants are confirmed by their clearing members, who then assume responsibility for all obligations. If trades are not confirmed, they become the responsibility of the trading member who entered them. This process ensures clarity and accountability in trade settlement. Clearing corporation receives trade details and computes settlement obligations using predefined methodologies. Obligations are generated and shared with trading and clearing members at the end of each day. Methods include daily mark-to-market settlement for futures, final settlement at contract expiry, premium settlement for options, and exercise settlement for in-the-money options. All obligations are netted, so clearing members have either a pay-in or pay-out for the day, ensuring efficient fund flow. Position limits are regulatory caps on the maximum exposure a client, member, or market participant can hold. These limits prevent excessive risk buildup and ensure market stability. Limits are specified at various levels, client, member, and currency pair, and are linked to total open interest or fixed currency amounts. By monitoring and enforcing position limits, regulators help maintain a balanced and orderly market, protecting all participants from systemic risk. Position limits vary by participant type. For example, trading members and institutional investors have higher limits, such as 15% of total open interest or a set currency amount, whichever is higher. Domestic clients and NRIs have lower limits, typically 6% of open interest or a smaller fixed amount. These limits are calculated daily based on the previous day's open interest, ensuring that no participant can accumulate excessive positions that might destabilize the market. Exchanges and clearing corporations monitor position limits at the end of each trading day. If a participant exceeds their limit, it is treated as a violation. The clearing member is accountable for all positions of trading members and clients clearing through them. Violations can result in restrictions on further trading, forced position reduction, and penalties. This vigilant monitoring ensures compliance and helps maintain market integrity. Settlement can be either cash-based or physical. In cash settlement, all open positions are marked to the final settlement price and settled in cash, which is the standard for currency derivatives in India. Physical settlement, though less common, involves the actual exchange of the underlying asset. The clearing corporation ensures that all settlements, whether cash or physical, are completed accurately and on time, maintaining the trust of market participants. Every day, open positions in currency futures are marked to market at the daily settlement price. Gains and losses are settled in cash on a T+1 basis, with all positions carried forward at the latest price. This process ensures that profits and losses are realized promptly, reducing the risk of large accumulated exposures. The clearing corporation handles all debits and credits through the clearing banks, keeping the system transparent and efficient. For cross-currency contracts, positions are marked to market in the quote currency, but settlements are made in Indian rupees. The latest FBIL reference rate is used to convert profits and losses into INR. This ensures consistency and transparency, allowing participants to manage their exposures effectively across different currency pairs while settling all obligations in the local currency. Option contracts are settled differently from futures. The premium for options is settled in cash on a T+1 basis, with the amount payable or receivable computed after netting positions at the trading member or custodial participant level. Unlike futures, there is no daily mark-to-market cash settlement for open option positions, only the premium is settled. For cross-currency options, the settlement value is converted to INR using the latest FBIL reference rate. Contract expiry, all open positions in futures and options are marked to the final settlement price and settled in cash on T+2. For options, all in-the-money contracts are exercised automatically and assigned to open short positions. The clearing corporation ensures that all settlements are processed promptly, and open positions cease to exist after expiration, closing the trading cycle for that contract. Clearing members must maintain separate clearing accounts for each segment with designated clearing banks. On pay-in days, the clearing corporation instructs banks to debit clearing members' accounts and credit its own. On payout days, the process is reversed. Non-fulfillment of fund obligations is treated as a violation and can result in penalties or withdrawal of trading rights. Regular settlement of running accounts ensures that client funds are managed transparently and in compliance with regulations. Robust risk management framework is essential for the stability of the currency derivatives market. The clearing corporation provides a settlement guarantee, ensuring that trades are settled even if a member defaults. Risk management measures include margins, liquid assets, capital adequacy requirements, real-time monitoring, and risk reduction modes. These measures are designed to protect the market from systemic shocks and maintain participant confidence. Risk management system includes online real-time monitoring, client-level margining, alerts on collateral utilization, and automatic disablement from trading when limits are breached. There are also capital adequacy requirements for members and separate settlement guarantee funds for each segment. These features ensure that risks are identified and managed proactively, minimizing the chances of default and market disruption. Margining is a critical process where the clearing corporation calculates potential losses on open positions and ensures members have sufficient liquid assets to cover them. Margins are collected at the client level, with no netting between clients or between client and proprietary positions. This approach ensures that risks are contained at their source, protecting the integrity of the entire market. Initial margin is collected upfront on all open positions, calculated using the SPAN system. SPAN, or Standard Portfolio Analysis of Risk, uses scenario-based analysis to determine the worst-case loss for a client's portfolio. Margins are based on a 99% value at risk over a one-day horizon, ensuring that even extreme market movements are covered. This sophisticated approach helps maintain market stability and protects all participants. In addition to initial margin, clearing members are subject to extreme loss margins ELM. ELM is calculated on the mark-to-market value of open positions and is designed to cover losses from extreme market movements. The rates vary by product and are collected in Indian rupees. This additional layer of protection ensures that the market can withstand sudden shocks and maintain orderly trading. Exchanges and clearing corporations may impose additional margins as needed, over and above initial and extreme loss margins. Clearing members can provide margins in various eligible collateral forms, such as cash, bank guarantees, fixed deposits, and approved securities. At least 50% of total liquid assets must be in cash or cash equivalents, ensuring liquidity and quick access in times of need. Clearing members must maintain a minimum liquid net worth, calculated as liquid assets minus initial and extreme loss margins. Liquid assets include cash, bank guarantees, government securities, and approved mutual funds. Non-cash collateral is subject to haircuts, and only a portion is counted towards liquid assets. This requirement ensures that clearing members remain financially sound and capable of meeting their obligation. 90% of a member's collateral is utilized. The system automatically triggers risk reduction mode. All unexecuted orders are canceled, and only immediate or cancel orders are permitted. New orders are checked for margin sufficiency, and only those that reduce open positions are accepted. The member returns to normal mode once collateral utilization drops below the specified threshold. This mechanism prevents excessive risk-taking and protects the market from sudden shock. Margins are collected up front from clearing members and their clients. The clearing corporation monitors total margin requirements in real time, comparing them against available collateral. If a member fails to meet margin obligations, penalties and disciplinary actions may follow, including withdrawal of trading facilities. This strict regime ensures that all participants maintain adequate coverage for their positions at all times. Trading and clearing members must collect initial and extreme loss margins from clients before trades are executed. Margins can be collected in various forms as specified by SEBI and exchanges. Any shortfall or non-collection must be reported, and penalties are imposed for violations. This ensures that clients are adequately covered and that the risk is managed at every level of the market. Protect client collateral from misuse. SEBI has implemented strict measures. Collateral must be pledged or repledged through the depository system, with a clear trail visible at every level. Off-market transfers are prohibited, and only approved securities can be used as collateral. This system ensures that client assets are safeguarded and used only for their intended purpose, enhancing trust in the market. Collateral is segregated and monitored at the client level, with detailed reporting by trading and clearing members. Clearing corporations provide web portals for clients to view their collateral status. Collateral allocation is strictly controlled, ensuring that each client's margin requirements are met with their own assets. This transparency and control reduce the risk of misappropriation and enhance the overall security of the system. Every recognized clearing corporation maintains a core settlement guarantee fund (SGF) for each segment. This fund guarantees the settlement of trades even if a clearing member defaults. The corpus is regularly stress-tested to ensure adequacy, and contributions come from the clearing corporation, stock exchange, and clearing members. The SGF is a critical safety net, protecting the market from disruptions due to member failure. SGF is funded by contributions from the clearing corporation, at least 50%, the stock exchange at least 25%, and clearing members up to 25%. In the event of a default, the fund is used in a specific order, starting with the defaulting member's assets, followed by insurance, clearing corporation resources, and then the SGF itself. This structured approach ensures that losses are absorbed systematically, minimizing impact on the broader market. Rapid technological advancements, maintaining robust cybersecurity and resilience is more important than ever. SEBI has introduced a comprehensive framework for stockbrokers, depositories, and clearing corporations. The framework focuses on anticipating, withstanding, containing, recovering from, and evolving against cyber threats. This ensures the integrity and security of market infrastructure, protecting sensitive data and maintaining trust. Cyber resilience framework is built on 5 key goals: anticipate threats, withstand attacks, contain crises, recover business functions, and evolve to minimize future risks. These goals guide market infrastructure institutions in developing robust systems and processes to protect against cyber incidents. By aligning with industry standards and conducting regular audits, the market remains secure and resilient in the face of evolving threat. Participants in the currency derivatives market must comply with a range of regulatory guidelines, including those from SEBI and RBI. These cover position limits, margin requirements, collateral management, and reporting obligations. Adherence to these guidelines ensures market integrity, protects investors, and supports the smooth functioning of the market. Regular updates and audits help maintain high standards of compliance. Sum up, the clearing, settlement, and risk management framework in exchange-traded currency derivatives is a complex but well-structured system. Clearing corporations supported by a network of intermediaries ensure that trades are settled efficiently and securely. Robust risk management measures, including margins, position limits, and guarantee funds, protect the market from shocks. Regulatory compliance and cybersecurity frameworks further enhance the integrity and resilience of the system. Market participants, understanding these mechanisms is crucial for effective trading and risk management. By adhering to margin requirements, monitoring positions, and staying informed about regulatory changes, participants can navigate the market confidently. The systems in place are designed to protect both individual traders and the broader market, ensuring a fair and transparent trading environment for all. As technology and regulations evolve, the clearing, settlement, and risk management landscape will continue to advance. Enhanced automation, real-time monitoring, and stronger cybersecurity measures are on the horizon. Staying informed and adaptable will be key for all participants. Thank you for joining us on this deep dive into the world of exchange-traded currency derivatives. We hope you now have a clearer understanding of the systems that keep this market robust and secure.